We would now like to talk about another example which has this information provided. It says that Amazon Limited has acquired a 40% shareholding in Nile Limited. Amazon has classified it as an investment in associate, and the same is accounted using equity method. During the year ended 31st of March 2020, Amazon has sold its product to Nile Limited at 1 lakh rupees, which includes a gross margin of 30%. Out of this, Nile Limited has sold goods worth 80,000 to third-party customers, and the remaining 20,000 is held as inventory at the year end. Now, what you need to remember here, what we discussed, in the previous section where we talked about the URP, the unrealized profits concept. We say that in case of an associate, you need to calculate the URP on, of course, the unrealized or unsold inventory, which in the given cases, of course, 20,000. Okay. The gross margin on this is 30%. That makes it 6,000. But then how much of that 6,000 are you going to call it as a duplication of profit or something which gets consolidated? We say it is going to be to the extent of your shareholding in that company, right? So that would be 2,400 in the given example. Okay, that's the first step. It does not matter whether it's an upstream transaction or a downstream transaction, right? The calculation of unrealized profit would be the same in both the cases. So this is something that we have got. Okay. Now, importantly, what you want to understand now is how does the accounting flow? Okay. We are given that Amazon has sold the product to Nile Limited. Okay, which means that the profits of Amazon have increased. Okay, and the inventory of Nile Limited has increased. Okay, and ideally speaking, they both are overstated, of course, in this scenario, and they both should be reduced. Okay, but then do we really consolidate the inventory of the associate? The answer is no, right? We do not consolidate this inventory. So how do we account for this adjustment? We say reduce the profit of the seller, right? It does not matter whether it is the investor or associate. It does not make a difference at all. Okay, so to the extent of 2,400, profits of Amazon will get reduced. So we said debit profit of Amazon, right? In the books of Amazon Limited, the profits will be reduced. So what would you reduce on the other hand? What is the second leg of this transaction? We say that it is the investment in Nile Limited. The moment it's a downstream transaction, the impact is on the investment, right? The moment it's a downstream transaction, the impact is taken through the investment in the associate. And that is how you address the requirement of the standard. Okay. This is something which is the explanation straightforward. The transaction represents a downstream sales made by the investor to the investee, which is the associate. Under the equity method under Ind AS 28, the related party must be deferred, of course, till the time the goods are sold eventually to an external customer. You cannot recognize the profit. Okay. For the 80,000 worth of goods, you can recognize the profit. So there is no adjustment required to be made. However, for the remaining goods, right, the transaction is not complete from the group's perspective. Okay, as the goods are still within the group, and of course, that intra-entity or intercompany profit should not be allowed to be recognized. And that is where we are saying that the overall gross profit margin was 30,000. Unrealized profit with respect to the inventory remaining is 6,000. The share of unrealized profit from the group's perspective, of course, is 2,400. Okay, and that is what we say, that you only take the extent of the share that investor has got. Okay, and this is different, of course, as we have discussed it beforehand. This is different as in the case of a parent subsidiary relationship, where the full profit is reversed. So that's the fundamental difference that you want to, of course, remember. Okay, the above calculated portion of unrealized profit is reduced from, of course, the investor's profitability, right? And because the seller is the investor and that is making the profit, so we need to simply reverse that profit. It would only be recognized when the inventory is eventually sold to an external customer. Okay, that's how you start looking at the group adjustments or consolidation adjustments in the financial statements in this context. All right, now there's another question. It says that during the year, Sigma Limited acquired 30% shareholding of Omega for a consideration of 5 lakh rupees. So this is the cost that you want to remember. Sigma Limited has concluded that it has significant influence, and Omega Limited accordingly is classified as an associate. Below mentioned are the details of the net assets of Omega Limited on the date of acquisition. The book value of the asset is 10 lakh. The fair value of net assets is 12 lakh. The above difference of 2 lakhs represents the higher fair value of machinery as compared to the book value. The remaining useful life of the machinery is 10 years, right? Now you would recollect, we have done these kind of discussions in case of the parent subsidiary relationship as well, where we had those fair value differences. Okay, it also says post acquisition, Omega Limited has earned a profit of 2 lakh rupees, of which it has distributed a dividend of 18,000 rupees. In addition to this, Omega Limited has recognized a fair value loss of 40,000 rupees in the other comprehensive income, right? The requirement is calculate the carrying value of the investment in Omega Limited at the year end using equity method. Okay, now let's go back and think about the concept once again, right? We said under the equity method, we will have the original cost and the share of profits or reserves subject to any dividends, right? That's a recovery of the investment that you have made, right? So when I look at this entire information, let's pick up what is relevant for me as Sigma Limited, right? What is the value of the investment I'm supposed to show, as far as the investment in Omega Limited, which is an associate, is concerned? We would say my original cost is given to me at 5 lakh rupees. Okay. Now, Omega made a profit of 2 lakh rupees, out of which 30% pertains to me. So that's my share. Okay. And then Omega declared a dividend of 18,000. So the dividend share will be 18,000 into 30%, right? And that gives 5,400. Okay. Also, there is a fair value loss through OCI. So we are also saying the fair value loss share, which is 40,000 into 30%. Now that gives me 12,000 negative. Okay. So effectively, if I just do the sum total of these amounts, that would result into the carrying amount of that investment that I have made in Omega Limited, which is of course my investment in associate, right? Let's have a look at the total. It says 5,60,000 minus 12,000 is 548, minus 5,000 is 543. So that should be 5,42,600, right? All the other information, the fair value differences, life of the machinery, etc., may not be relevant here. So maybe they're giving it just to confuse us. Okay, so we just need to kind of assess what is the significance of the information provided and what is the requirement of the question there. Okay, let's have a look at the formal solution. This is something that we have done.